Hello, everyone, and welcome to another episode of the Market Snapshot series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So today, we will be looking at the current events that are influencing the markets. So we'll also be focusing on the economic calendar, and once we go through that, then we do some technical analysis to try and understand the current market patterns and where the markets might be headed next. So it's also important to note that this is not investment advice, neither is it a recommendation to trade. So this is purely educational. So you always have to make your own investment decisions. Of course, practice proper risk management. So hello, Casper, and good morning. Hello, Armstrong. You can see J Score in the house. Hello, Armstrong yet again. Thank you. A peaceful morning. So hopefully we will be getting some tips from the markets today. So today's session will be a little bit shorter than usual since there's not much to cover. So as we all know, whenever we are looking at the markets, be it on a Monday, Tuesday, or even on a Friday, the thing is, at some point, in some days, there will be a lot to cover. Sometimes there will be something in the market, and sometimes there will be nothing in the market. So luckily for us today, we have something coming up in the market. So hello, Mana, and thank you for joining. So now that that's out of the way, let's get things started. So I'll be starting by a very quick overview of the economic calendar. So clearly, we didn't have much happening in the markets. I think I need to put my filters here and make sure we are covering all currencies in the markets. So we had CPI in Switzerland moving slightly to the upside. CPI in Japan being slightly downwards. And now we are focused on the major CPI news from the US. And for those who are new to the session, you should know that CPI is short for Consumer Price Index, which is a measure of a basket of commodities that are consumed by the average household in the US, and these helps track the movement of prices. So when the CPI price is moving higher, it basically means that money is value, and in that case, we say inflation is increasing. So if CPI is moving downwards, then we say inflation is reducing. And in this case, we will be focused on the rate of inflation in the US for both the month of December as well as the last 1 year. So the month of December, there is an overall consensus that prices moved up on average by 0.2%. This is an increase from a previous increase of 0.1%. So we will be focused on the actual data that will be reported at 4:30 p.m. East African time today. So in this case, if inflation is on the rise, we'll be expecting some high volatility. And of course, the key focus will be on also the other data, the annual CPI, which was previously reported at 3.1%, and now is expected to have moved slightly higher to 3.2%. So we'll also be looking at core CPI, which is the Consumer Price Index basket, without the food and energy prices. And this is expected to have increased by 0.3% in December, and a further increase from the previous 0.3% increase in the month of November. So knowing what we know that the US monetary policy is directed by its central bank, the Federal Reserve, which we abbreviate as the Fed, FED. So the Fed has been tightening policy for the last 2 years. And in tightening, basically means that it has been increasing interest rates, which moved at the fastest rate ever from around 0.1% to an upper bound of 5.5%. So there is a lot of speculation in the market that the Fed may go ahead and cut interest rates, and this would be happening as early as the March 20th meeting. So one of the key conditions that the Fed has been presenting for that potential pivot is the inflation getting to target. So the central bank target or the Fed target for inflation is 2%. So as you can see, the previous reading was 3.1%, which was still 1.1% higher than the Fed target. So this makes it harder for the Fed to decide on cutting interest rates. So investors are looking forward to this data getting lower and lower and closer to the 2% target, so that Fed may eventually go for that rate cut. So in this case, investors will be looking to react to the inflation report. And in this case, it will be an attempt to front run the Fed. So if inflation is on the rise, basically means that the job is tougher for the Fed. So the Fed may have to hold interest rates higher in order to control the rising inflation. So in this case, when we see the Fed holding interest rates higher for longer, it basically means that bond yields continue rising and the demand for the dollar continues being high. In that case, we'll be seeing a strengthening US dollar. So on the other hand, if inflation is moving lower towards target, and in that case, potentially dropping below 3.1%, then we should be expecting to see a Fed that is more confident in cutting interest rates. In that case, we should be seeing a much weaker dollar. As for the equities side, and in this case, I'm talking about US benchmark indices like the S&P 500, the NASDAQ, Dow Jones, the Russell 2000, we should be expecting the equities to be reacting to a potential rate cut. So we know that when the cost of capital is much lower, that is when interest rates are lower, there's more money flowing into the US economic system, and as a result, it tends to lead to higher stock valuations. So rate cuts are much welcome to the equities market. So if there's more rate cuts be expected this year, then it should be bullish for equities. So in this case, if inflation is behaving as expected, dropping below 3.1%, then we should be expecting a strong rally to be happening in equities. Then if inflation is on the rise, then we could be seeing equities weakening. So that's the overall expectation for the day. It's the most important news of the day. So make sure that you are tuned in at 4:30 p.m. And by tuned in, I don't mean in a webinar. I basically mean that you be watchful charts, trying to understand the news outcome and how the market will be reacting to this information. So as we proceed, if you have any questions related to the presentation, feel free to type them in the live comment section, and I'll be ready to respond as we continue this session. So hello, Mana, you can see Brian and yes, thank you guys for joining. So we have a participant who is listening in from Zambia. I am assuming from the name, yes, for example, Zambia. So guys, for any Kenyans in the house, let's say hi to Martinez on the live comment section. We appreciate whenever we have more listeners from different countries. So hello, Charles. So on the next part, we will be looking at an article that was posted on CNBC, trying to give a brief outlook of the expected CPI news today. So the article title is Thursday's inflation report could challenge the market outlook for big Fed rate cuts. So key points, the consumer price index is projected to have increased by 0.2% in the final month of 2023, or 3% for the full year. There is a wide gap between what the Fed has indicated in terms of rate cuts and what the market is expecting. The Fed's central mission now is calibrating policy in a way that it doesn't ease too much and allow inflation to return, or hold policy too tight so that it causes a long anticipated recession. So as we all know, if the Fed keeps rates high for too long, then basically tends to be negative for economic growth, and it might lead the US economy into recession. And then if they are hasty and they cut interest rates faster than the economy, then in this case we should be seeing negative effects coming in from this. So by cutting rates, normally lead to another pressure pushing inflation right back upwards. So that tricky balance is what the Fed is trying to navigate in order to get into what we describe as a safe landing. So if the Fed tightens too hard and the economy gets into a recession, we call that a hard landing, basically a crash. But then if they're able to achieve 2% inflation without causing much harm on the economy, then that can be described as a soft landing. So economists expect that inflation nudged higher in December, a trend that could call into question the market's eager anticipation that the Federal Reserve will slash interest rates this year. So the Consumer Price Index, a widely followed measure of the costs folks pay for a wide range of goods and services, is projected to have risen 0.2% in the final month of 2023 or 3.2% for the full year. This is according to the Dow Jones. So I'm trying to skim through the article real quick. So after months of insisting that easier monetary policy is still a ways off, central bank policymakers in December penciled in 3/4 percentage point rate cuts by the end of 2024, effectively a policy pivot for this inflation fighting era. Minutes from the Fed meeting released last week did not indicate discussions about a timetable for the interest rate reductions. So markets are currently holding a different view. So let's see what the markets are saying. So I'll be using the CME 30-day Fed funds futures to show you what is being priced in the market right now. So the next meeting by the Fed will be on the 31st of January 2024. And on the 31st, there's a 97.4% probability that the Fed will not be cutting interest rates. Rather, it will be holding interest rates at the current level of 5.25% to 5.50%. However, if you jump from January and look at the next meeting, which is the 20th of March, then you see the big shift in expectations in the market. So currently, investors are expecting a 67.1% probability that the Fed will cut interest rates to 5.0% to 5.25%. And this represents a 25 basis points cut for the current rate. So there is increased confidence that the Fed will be cutting interest rates in March. So there's still some probability that it may hold interest rates at that level. The probability is 31.2%. So if you move on to the next meeting, which will be on the 24th of May, then there's still a further probability that the Fed may go for another rate cut, which would push US interest rates to a range of 4.75% to 5%. So as you can see, the market is pretty optimistic that the Fed is pivoting, and we should be seeing at least 3 rate cuts happening this year. So back to the article, looking for easy. So traders in the Fed funds futures market are pointing to a strong chance of an initial rate cut in March, be followed by 5 more reductions through the year that would take the benchmark overnight borrowing rate down to a range of 3.75% to 4%, and this is by the end of this year. So if inflation data, such as last day's morning CPI release, so remember when we'll be getting the CPI data, it will be morning in the US, but for us, it will be in the afternoon. And of course, on Friday, which is tomorrow, we'll be looking at the producer price index. They both don't show stronger inflation progress. That is liable to cause more volatility in a year when stocks have already gotten off a rocky start. So we are going to see it across all markets because it's going to be that dynamic between what the Fed is doing and what the market expects them to do. So McIntyre said of a likely volatile time ahead. Ultimately, they've got to come together. It probably means that right now the market needs to give back some rate cuts that they have already priced in. So the market has been pricing in the rate cuts since late last year. By pricing in the rate cuts, basically means that investors have been selling the dollars. Bond investors have been selling, expecting that the rate cuts will push yields downwards. And of course, the rate cuts are bullish for equities. So we saw a big rally happening in December with the US top equity indices, SP 500, NASDAQ, Dow Jones, all hitting new all-time highs. So these all-time highs were as a result of the market pricing in the early rate cuts this year. So the rate cuts are majorly influenced by the Fed's decision. The Fed is basically tracking data. So from the last couple of meetings, the Fed has consistently said that it has switched to a data-dependent approach. So they are all focused on the data coming from the US economy. And these extends from the job market report, so the non-farm payrolls last week on Friday, with downwards revisions indicating that the job market has been softening and in line with the Fed's expectations. And now we focus on the inflation data or the inflation report. So these will be very instrumental for the next Fed decision. So as a result, we now focus on this data point as the key driver of the markets today. And in fact, if we happen to see a stronger inflation, then that could cause out of surprises in the market. But then if the inflation is weak, then the current pre-existing trends continue. So another article here, and this is from a meeting by one of the Fed members called post-week. It happened yesterday in the, 3 days ago, So Atlanta Federal Reserve President Raphael Bostic said on Monday that with inflation still above the central bank's target of 2%, his bias is for monetary policy to remain tight, even though overall risks in the economy have become balanced between those posed by rising prices and those posed by slower employment growth. So I've got a natural bias to be higher. This is Bostic's comments. And this was at a lunch event with the Rotary Club of Atlanta. I don't know if that's how we pronounce it. I believe it's something along the lines of Atlanta, but in Kenya we mostly say Atlanta. I don't know why we pronounce it like that. So on the next part, now we focus on yet another update. So the annual inflation in the US likely edged up 3.2%, and this is something I've said over and over, but then it's important to focus on the overall data. So for the last 1 year, you can see inflation consistently moving downwards from 6.5%, 6.4, 6.5, 4.9, 4.13, and then rising for 2 consecutive months to 3.2, 3.7, then it stayed level at 3.7 before dropping to 3.2 and then 3.1%. So in this case, we're expecting a slight increase to 3.2%, but then we have not yet gotten to target. So if we do a bigger curve here, you can see the rally that happened from the COVID era. And this was as a result of the insane amount of money that was injected in the US economy during COVID. But then after that, we can see the market moderating and inflation coming back downwards as a result of the aggressive Fed tightening policy that has been happening over the last 2 years. So knowing this and now looking at the charts, now we will have an understanding. So looking at the NASDAQ, you can see that it has been pretty strong since October last year. There has been a very strong rally as investors priced in potential rate cuts. So after this pullback that happened, and this was on the first week of January, on the second week, you can see we are almost reversing everything. So the big sell-off that happened on the first week has completely been recovered. And now the market is strongly pushing towards the previous high. And once we get to 16,979, then we will be exploring a new all-time high for the NASDAQ. So it seems to be strongly correlated with other pairs. So for the US 500 or the S&P 500, then you can see the market has already cruised above the previous high, and now we are trending on high or higher grounds, and very close to creating another all-time high. So as for the US 30, or what we describe as the Dow Jones, so from the forward chart, we have just hit the previous high, and we are on the verge of creating yet another all-time high. So all-time highs tend to be quite violent or tend to be quite strong. So in this case, there is a good likelihood we'll be seeing a strong upside here. So we will be watching here, especially after the announcement of the CPI data. And as I said, if the inflation is higher than expected, then the Fed might consider holding interest rates high for longer, and that would completely reverse this trend. So despite the US equity indices being strongly upwards, we could be seeing a very strong reversal playing out today, and this would be as a result of high or a surge in inflation. However, if we happen to see inflation behaving in a moderate way, in this case, it could be moderating to 3.1% or below, then in that case, we see a strong breakout above the all-time highs. So that's the angle on US equities. So another key important event, you all remember about the Bitcoin spot ETFs. With Bitcoin spot ETFs, we know that there has been a multi-year struggle to make sure that they are approved. So there was a fake incident yesterday, slightly past midnight, and that fake incident is when the SEC Twitter account was hacked, and someone basically posted that the ETFs have been approved, leading to quite a wide volatility. So you can see how Bitcoin spiked up and then back downwards and then moderated. Then for the rest of the day, traded downwards and then later recovered. So yesterday, just around midnight, there was news that the ETFs have already been approved. That is after the market close. Then they are expected to be starting trading today. So when the market opens at 4:30 p.m., expecting to see increased volatility in Bitcoin as these ETFs gather more funds and allocate more money to Bitcoin. And as a result, these are increased expectations that we could be seeing very strongly resulting from that. So a lot of investors are anticipating the US market open, looking for that opportunity to squeeze in some bullish positions for Bitcoin. Of course, the near-term target is the previous high, which is around 48,000 or slightly below 48,000. So we could be seeing a strong rally in Bitcoin moving 48,000. And from the current price level, if you try and estimate the movement, this is something around 3.79%. So as for the dollar, this is how the dollar index has been forming. So clearly, the dollar index has been on a rest or basically trading within a range. So it hasn't been moving up or down. It's more of a sideways momentum. And a lot of investors have been waiting or anticipating the CPI news. So for 6 straight days, it's just moving sideways. So we can basically say that the only day we have seen a strong momentum in the dollar index was on the 2nd of January. But for the rest of the days, we have just been seeing some sideways momentum. However, if you go to the forward chart, you notice that the dollar was largely bearish last year, and this year is just starting to recover. So if we cement the idea of the dollar basically, the idea of inflation being on the rise again, then the Fed must hold rates higher for longer, leading to a much stronger dollar. So we could be seeing the dollar index make a very strong rally and get to this area, and potentially even break higher if inflation is on the rise. However, if inflation is not on the rise and it's moderating as expected, then the potential for the dollar index could be dropping back to 100.28. So this is a very real possibility. How do you take advantage of this? You want to pair the dollar with something. So there's quite a number of pairs in the market. And I believe the Japanese yen has been pretty weak. So the USD JPY, since the beginning of the year, 2nd of January, it has been only moving up, pulled back on Friday and Monday, and then continued higher. Basically indicating that the JPY is currently a weak pair. And if you compare other currencies, you'll notice that it's true. The Japanese yen has been losing against its peers, and that would be a continued possibility, especially if the dollar was to strengthen after the announcement later this evening. So if we see inflation on the rise, the dollar is expected to strengthen, and one of the candidates would be strengthening against the Japanese yen. So as a result, there is increased expectations that we could be seeing a recovery in USD JPY, and one of the key potential targets remains 147.142, which was a previous bottom and now might be turned into a resistance. So we could be seeing the market moving all the way up and getting to 147.142, and this is based on the premise that the dollar strengthens as a result of a strong CPI. But then, what happens if the dollar weakens? So if the dollar happens to weaken as a result of a weaker CPI, which leads to the potential of early rate hikes, then you want a stronger currency to pair that with. So in this case, the euro and the pound tends to be strong candidates. And as you can see, within this range, which is something we tracked yesterday on Monday, we saw the euro USD bouncing from the lower trend line and continued to push higher. So we had a target here of 1.09773, which has already been hit. And now there's that potential that the euro could continue strengthening against the dollar. So this could be the basis of a strong rally towards the previous high. So if the euro was to strengthen against the dollar, then the potential is the market heading all the way up to 1.11396. So this is enough leg room for any trader to squeeze in some good pips and make some profit. And this is based on the premise that inflation comes in lower than expected, and as a result, the dollar weakens the euro. So it could also play out in gold as well as on the pound. So for the pound, we can already see that we are testing a major resistance level that has been pretty tough to break. And now, judging by what the news may present, so if there's a case of much lower than expected inflation, then the pound breaks out higher. Of course, there's a potential target nearby of around 1.28271. On the other hand, if you go to the daily chart and you look at the overall movement, you will notice that the pound was losing to the dollar, and this was for a couple of months. Then in the last 3 months made some recovery, but we are yet to have the full impact. So in this case, there's a potential that the market could eventually make a full recovery. The trend could be starting as soon as today. So while there's a projection all the way up to 1.31365, a very short-term target would be on the previous high, which is somewhere around 1.28476. So we could be seeing the market making a very strong rally to that area. And for the forward chart is how it looks like. So we could be seeing the market going for this level here, which is slightly above the highs that we have seen in the recent weeks. So there's still more room for upside. So the premise of a much weaker dollar could lead to increased bets on bullish positions in pound USD. So as gold, it has also been consolidating. So across board, it seems like the market has just been waiting for the CPI news to make a decision on the next set of direction. So there's a trend line here, judging from the previous highs here. Sorry, 3. So this is the first high here. Second one is right here. And the third one is right here. So it makes it a pretty strong trend line. So a strong gold rally against the dollar means that the actual report shows some form of moderation in inflation, leading to the belief that the market would be headed higher. So in this case, judging from these pricing points, there's that potential that gold make a strong rally and eventually get to $2,045 per ounce. But then the opposite is also true. We could also be seeing the market drop to the previous low of 2016 which would be on the premise of a much stronger dollar, leading to a big sell-off in gold. So as for oil prices, I expect to continue seeing much more weakness. So remember, for the better part of the week, Monday and Tuesday, I insisted that it's better to wait and for short selling opportunities. Then got some reversals coming in yesterday on inventory prices, and today it seems like we are continuing with this pullback. So the potential for the market continuing this movement, eventually dropping to this support area of $75.171 per barrel, would be playing out today. So from the result of the news that we got yesterday, and I want to show you this. You go to the economic calendar and you look at the crude oil inventories in the US. They were on a rise higher than expected. So previously they dropped by negative 5.5 million barrels per day. Sorry, not per day. This is just stock. And now we expected an improvement to negative 0.2. In this case, there was an increase of 1.3 million barrels, basically indicating that supply of oil is increasing, which has the impact of pushing prices lower. So as a result, you can see the volatility that came yesterday in the evening. So some further downside momentum, and today I expect to see a continuation of the same. Of course, the key level support is around $5.171 per barrel of oil. So European equity indices have also been on the rise, and I expect them to be behaving in line with American equities. So sometimes when there's a strong movement in US equity markets, it tends to affect European equities. In this case, for the French 40, Euro 50, as well as the UK 100 indices, I expect them to track the performance of the US equity counterparts. So in this case, if equities in the US are rallying, then also in the EU, I will be expecting a continuous rally. So for New Zealand USD, we'll be monitoring this particular trend right here. And as the market tests this area, you know that the next set of momentum might be influenced by the outcome of the CPI news report. So for USD CHF, it's still the same thing. Now that we are seeing the trend line moderating somewhat. So in this case, we will be observing this particular trend line. Of course, if we happen to see a much weaker dollar, then we'll be trading back towards this trend line. So in this case, after the announcement, there's that potential that the market heads back to the lower trend line. And then the potential for a break towards the upside is also in play. And we could be seeing the market making a very strong rally and eventually getting to 0.85752. So this one is based on the trend line. Sorry for deleting that. So we want to see the market pushing towards that support or this resistance based on the outcome of the news. So if you already have positions in the market, make sure that you do proper risk management or even exit to avoid the impact of high volatility that might come as a result of the news at 4:30 p.m. So that's it for the day. Thank you very much, guys. I'm seeing there's quite a number of commentary, so I'll try to go through it quickly. Hello, Abdul Nasil. Talk of oil. What does the Angola defection mean to OPEC? Is it a harbinger of more defections? So by Angola moving out of the OPEC is that it wants to set itself outside the limits of OPEC. So if in the OPEC you get an allocation of the amount of oil you are supposed to be producing per day, per month, per year, and if you're outside, then you are free to produce as much as you want, and as a result, this basically increases the supply of oil in the markets, and with higher supply, it basically implies lower prices. So remember, the reason that OPEC Plus countries come together to form this cartel is so that they can control prices. So the more of the supply they dominate and the more supply cuts they implement, then they can artificially prop up prices. But then when they are losing members, they are losing power, and as a result, would be seeing much weaker oil prices. So hello, Cloud Sauna. How does CPI affect the price of oil? I don't think there's a direct angle. I would rather focus on demand versus supply of oil rather than CPI. Could you please explain just a little how the CPI affects a currency pair, e.g. USD/JPY? I think I've already explained that. Took some good time pointing that out. From a macroeconomic standpoint, Fed and fiscal positions are known. What do you anticipate to move the markets in the year 2024? Noted that 2023 moves were muted across pairs, i.e. less 50 of 2022 move. I think this year's volatility is expected to come in from how aggressively central banks start cutting interest rates. So in this case, major central banks include the Fed, the Bank of Canada, RBA, RBNZ, Bank of England, and the ECB. So in this case, we are focused on potential rate cuts, and we know that at least one central bank will crack by March or even April. And as a result, that would lead to a weakening of its currency. So in this case, we'll be looking to trade a divergence between one of the Western central banks and one of the Eastern central banks. And from the East side, there's a good chance that the Bank of Japan might start hiking interest rates. So when you have one central bank hiking interest rates and another one is cutting, then that divergence can create very strong trends, just as we saw with the USD/JPY over the last 2 years. So, hello, Doug, and welcome to the session. So easy money was credited for the rally in stocks, which even Fed admitted fraud on the asset prices. So now the Dow Jones and Nasdaq has cleared all-time highs on anticipation of rate cuts. How do you explain this? So the thing is, the reason why equities were making a very strong rally last year was because of fiscal spending. So while on one side, the Fed has been hiking interest rates and trying to remove fraud from the system, the administration, which in this case is led by Biden and his control of the Senate, has been passing more and more bills to increase spending within the US. So if the government is spending more money, then this money ends up in the stock market. As a result, we continue seeing strong valuations. So until the appetite for fiscal spending starts reducing, then there's a good likelihood that the equities continue to vary. Is it possible to explain the rise of Indian economy in bullish banter? We try to focus on the most or the majorly traded assets on the platform so that we can provide value to as many clients as possible. But it's an awesome suggestion and we will be considering it. Another good question from Samuel. Why is it that I'm able to identify patterns easily, but I have a consistent flow of accounts? I think it's a risk management issue as well as a discipline issue. So you might want to check on the lot size you use, the frequency or the number of trades that you implement in a given day or week. Of course, how well you follow your trading plan. So in most cases, if I see a trader losing money, there's a good likelihood, and I could be wrong on this one, that you have a large number of winning trades and a very small number of trades that eventually wipe your account, trades that where you lose your discipline and let the losses continue to run. It's very rare for a trader to lose an entire account for losing small amounts. So if let's say you risk 1% and you just keep losing and losing and it goes down to zero, it's very, very rare. Most of the traders that will blow out their accounts will have like, let's say 500 winning trades and then 2 losing trades that wipe out everything. So it's more of a discipline issue rather than your performance. Another good question from Fahad, assuming it's the right pronunciation. USD JPY, how is the expected trend today? I think you came in late to the session because I already explained that. And I mentioned that USD JPY might become a favorite pair if the CPI comes in stronger than expected. And in that case, the Fed considers holding rates higher, the dollar strengthens against the yen. But then if the dollar weakens, you want to trade that weakness against a stronger currency. And the candidates, as I've mentioned, is pound USD, euro USD, as well as gold. So thank you very much, guys. Remember, we have another session at 8 p.m. At 8 p.m., we'll be doing an overview of the report, trying to see what happened, how the markets react, and where the opportunities lie. So make sure that you stay good your screens. If you think you're making the wrong decisions, sometimes traders will blow their accounts trading news. Just go outside, touch some grass, relax, then come back tomorrow, and hopefully you avoid that adrenaline of that may result in you blowing your account. So as I end the session today, I urge you all to practice proper risk management. Don't go all in. Don't try supernormal lot sizes. Just trade as usual. Just take the incident as just another market announcement. Risk the same amount that you would risk on any other day. And in case you are not mentally prepared for this, you can always take the day off. But if you're prepared, then by all means harvest those pips and make some money for yourselves. So thank you very much, guys, and I hope to see you on the next one. Remember, it's still today at 8 p.m. So if you haven't subscribed to the channel, make sure that you subscribe so that you can get notifications whenever we have a live session going on.